Hello, my name is Ioana and I will be presenting the paper Volatility Dynamics of Crypto Assets written by Raluca COITA Ioana and Codruta MARE. This paper is presented during the 4th IBIMA International Conference. Here is a short agenda of the structure of our presentation. So we will start with the introduction. The objective of our paper is to select the optimum model and set the useful models for modeling the 5 most popular cryptocurrencies associated volatility. The assessment is based on Garch models, and the best fitted model is selected through maximizing the likelihood and minimizing the AIC and BIC information criteria. Conclusions are drawn regarding performance of the models in terms of investing on the crypto market. So, Bitcoin, as the most popular and traded cryptocurrency, has experienced extreme fluctuations since its introduction in 2009. As mentioned above, crypto market captured the interest of investors in the last years, despite the risks related to crypto assets, especially in the high volatility and lack of transparency and investors' protection. These elements made academics to study crypto assets volatility using different tools, with the objective to understand in depth how the crypto market is functioning, the factors influencing the price, and other aspects. Price swings and unusual dynamic of the crypto market show the need for modeling the conditional variance of crypto assets. Modeling volatility is important for risk management. In traditional finance, the asymmetry in volatility process is detected using the GARCH models. Recent studies have implemented different GARCH models to study the volatility of various crypto assets. In order to select the best model or the right set of models, we consider relevant to continue the investigation of crypto assets volatility, and in this context, we intend in this study to select the best model that could fit under different error distribution for effectively modeling volatility relating to the 5 most popular crypto assets. Classical financial literature on estimating volatility in the crypto market tells us that ARCH model was developed into GARCH by Boleslav in 1986 by adding conditional heteroskedasticity moving average to the model so that the current volatility is estimated based on the past. Later on, several models were developed based on GARCH, like the one by Nelson called eGARCH and LGARCH by Giweke in 1986. Introducing multivariate mGARCH model is brought by a dynamic and flexible structure and that allows for calculating volatility and co-volatility in the portfolio. In this sense, Fakreh and Joribi 2020 proved that majority of cryptocurrencies turn out to be rather effectively modulated by the T-GARCH. Their findings report an asymmetric effect whereby volatility turns out to increase rather by a response to positive shocks than by response to negative shocks. This result implies an asymmetric effect that differs from the generally observed in stock markets. Bitcoin investment in terms of portfolio diversification is using the Kepler-Garch approach. Their results reveal that volatility modeling provides better results with a dynamic conditional correlation model. The portfolio diversification model is used while Bitcoin's contribution to the portfolio is more attributable to its risk than its return, and it does play a role in stabilizing portfolio performance. Urquhart 2017 tested HAR models in comparison with GARCH and found that there are no better in modeling volatility jumps, but proved to have a higher degree of information. Paraskevi 2017 finds out that in goodness of fit to data is RC GARCH. IRAS 2021A finds out that by adding a meta-learning strategy to the Garch model, he obtains higher performances that other types can offer by testing 110 Garch models. Using supervised learning models, now other studies shown that people's perception on crypto assets is mostly positive during present turbulent times caused by war and energetic crises. Several studies found some spillover correlation from Bitcoin to Ethereum and Litecoin from 2015 and to 2018. Using Coppola, Garch, Hafar, and Lefort 2022 observed that Bitcoin acts as a stabilizer in a portfolio of crypto assets due to its risk properties. So, asymmetric effects between good and bad news are traditionally modeled using threshold Garch that allow only for two possible variance regimes. The results showed an inverted asymmetric variation for the majority of cryptocurrencies. The presence of positive return volatility relationship shows it different from other traditional assets, supports the affirmation, the hypothesis that says that safe haven is Bitcoin in cryptocurrencies. Chu et al. In 2017 test several Garch models on the 7 most popular crypto assets. Font, Geong, and Pereira 2021 test 258 cryptocurrencies and 8 models of G-Garch. They find that T-Garch outperforms other models. They find that good news has more impact on volatility than bad news. They also conclude that the crypto assets analyzed act as a safe haven. Other study investigates the volatility behavior of DeFi cryptocurrencies and find out that they also act as a safe haven in comparison to traditional assets. The findings show the superiority of the iGarch model when it deals with forecasting the volatility of world currencies mentioned. Other studies, for example Dierberg 2016, compared the volatility of Bitcoin, gold, and the US dollar using the Garch and eGarch models. Crypto market presents interest in being studied even before COVID. And now even more after the changes we have saw in all traditional asset markets and in the innovative one. Crypto issuers argue that crypto market is agnostic to the political changes, economic policies, and other macro indicators, and are not controlled by central banks. In addition, the crypto market experienced after 2018 the most rapid fall in the price of cryptocurrencies. That makes the volatility of the cryptocurrencies an important element to be studied in the objective of better understanding this market. So we are studying the first 5 cryptocurrencies included in the analysis: Bitcoin, Ethereum, Binance Coin, Cardano, and Ripple, selected according to market capitalization. Data was collected from Crypto Compare platform. The selection of crypto was based provides a set of benchmarks, and we extracted the closing price data for the 5 cryptocurrencies from the period February 2018, June 2022, with daily data for the entire period. During this period, there was the fastest decline in cryptocurrency prices, so great interest to assess and analyze the determinants of yield volatility. For the analysis, we calculated the daily logarithmic profitability. Garch processes differ from homoscedastic models, which require constant volatility. This volatility of asset returns appears to vary over time and depends on past variation. So estimating the Garch models under different error distribution conditions was done. We also modeled effects on conditional volatility. Our hypothesis states that negative news is associated with higher volatility while positive with a lower one. To detect various features and patterns in price dynamics for crypto assets, we use this Garch modeling. The rentabilities of the crypto assets included in our study are Bitcoin, Ethereum, Binance Coin, Ripple, and Cardano, and are presented in the figures 1 to 5. So we can see here the rentabilities of the 5 cryptocurrency that we used in our study. As the plots show, the time series of returns have no trend and no intercept, so the ADF test was applied with none option. The ADF test confirms the stationarity of all variables. Figures 1 and 5 indicate that all crypto assets are sensitive to certain shocks and suggest periods of very high volatility, this being common in the feature of among crypto. We also studied the autocorrelation of rentabilities, and the results show that all returns are autocorrelated except the case of Ripple. In order to test the arch effects, we have constructed the ARMA models for each of the variable and afterwards applied the arch test on the residual values. Results of these tests are presented in the table below. As we can see, the results indicate that in the case of Bitcoin, it's not possible to apply arch as heteroscedasticity is not present. For Ethereum and Cardano, we identify that we have at level 1, and in the case of Binance Coin and Ripple, level 2. So, in our paper, we investigate the volatility of the crypto assets, estimating different types of gauge models, and in the end, selecting the most appropriate model using AKIK information and Bayesian information. Parch models explain and fit better in terms of volatility for all crypto assets included in our study. We estimated in the case of Bitcoin, and in order to show that heteroscedastic phenomena are not present and it is not relevant to estimate gauge models. Still, we identified that for eGauge and Parch, that coefficients are significant. The results obtained in our study contradict, for example, Hotopos, Naimi, who show that superiority of eGauge in modeling the Bitcoin is. So in other cases, our findings confirm the theory of Naimi, Haddad, Fernandez, Ercori 2021, suggesting that advanced models, mainly pGauge, explain better the volatility of crypto assets. So the results of the models tested are here presented in the table 2. So we can see that the pGauge is the most performant of the models. Our results are important and useful for potential investors in addressing risk management. The results of our study are important for further investigation on the complementarity or suitability of crypto assets. They show that all crypto assets, especially Bitcoin, are characterized by extreme volatility, and the comportamental point of view as crypto users are very sensitive and reacting to media information or big players' behavior in relation to crypto. They are in line with previous research showing that there is a volatility transmission between Bitcoin and other cryptocurrencies. Our results confirm the asymmetric share of information inside crypto market due to the high volatility and high returns periods inside the intraday trading volumes. All crypto assets display higher volatilities after COVID period than before the period. Thank you for your attention.